Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. After the biggest bank failure since 2008, causing quite a bit of a panic in the market, we've actually seen the Federal Reserve's balance sheet expand here. The Fed has been on a mission to fight inflation, reducing its balance sheet through quantitative tightening. And now with the recent banking crisis, the bank runs that we've had following the collapse of SVB on various regional banks, we've seen the Fed step in to provide liquidity, leading to another balance sheet expansion for the first time since 2021. Of course, we all know the big theory behind the influence that the Federal Reserve's balance sheet has on the market. We've seen that drive the market up and down throughout the last decade, and the most recent example of that was, of course, in 2020, a massive expansion of the Federal Reserve's balance sheet, leading to a massive inflation of asset prices. Now, the most recent balance sheet expansion and generally just Fed intervention actually created quite a nice bounce on the market. A lot of people got excited about this. The market ran up 4% off its low. It gave back some of those gains on Friday. So in this video, we're going to take the contrarian outlook and explore why the balance sheet expansion that we're seeing, why the fact that the Federal Reserve is stepping in to essentially bail out the banking system from a crisis, why that won't necessarily translate into a higher stock market. I'm going to show you a few charts that give quite a bit of insight regarding where the market should actually be right now and what insiders right now, corporate insiders, are doing with their stocks. If you are new here, don't forget to smash the subscribe button and of course smash the like button if you enjoy this episode. Now, without further ado, let's get right into it. Before I do get into this video, make sure to take advantage of the flash sale that we're doing on our membership prices. We have under 24 hours left between the time this video is posted and the end of the discount. We're building what I believe is the ideal macro trading investment service. I also believe that we're perfectly positioned for the macro environment that we're heading into. We're ready to take you every step of the way throughout this crisis. Make sure that you don't get hurt throughout this period and possibly that you can even benefit from it. So if you want to lock in a membership at a cheap price, make sure to do that now. Now, if we look at the banking sector, the regional banking sector, you can see the massive drop that we've had more recently. And look at the rate of change that we've had here. This is the fastest drop in banking stocks that we've had since COVID. Before that, 2018, 2015, 2011, and then July of 2008. Now, of course, except for 2008, you didn't have a real banking crisis in these episodes right here. But what is the real difference between what is happening today and all of these examples right here? And the answer is that inflation is still sitting at 6%. So unlike all of these examples here, 2020, 2018, 2015, where you had very low inflation, the Federal Reserve in these examples was able to step in, calm down the markets by easing monetary policy very significantly. Even in 2008, the Federal Reserve was easing monetary policy significantly. Now, there's lots of differences between what is happening today and what was happening in 2008. But one of the key themes today is that the market knows that the Fed is very unlikely to step in with full force and full conviction. They're going to do what they need to do to save the banking system, but they're not going to start cutting rates all of a sudden like they did here in 2019, like they did here in COVID. In 2011, they started QE again. So the Fed has very little room to really jump in and save the market. Now, next week, they're going to talk about a pause. They're going to talk about the risks to growth, the fact that inflation has come down significantly, but they're not going to be able to do much more than that. Inflation is at 6%. If they begin to cut rates now, which is what they would have done at any point in the post-financial crisis period, if they do that now, they lose all credibility in the fight towards inflation. You wonder why gold is skyrocketing all of a sudden? That's exactly what the market is worried about, that the Fed is really no longer in control of the situation. And that's actually something that we saw in 2008. If I add the Federal Reserve's balance sheet again on this chart and take a look at what was happening here in 2008. Now, a lot of people like to only show this part of the chart where indeed you see balance sheet trends correlate with stock market returns in general. If you zoom out just a little bit more and you take a look at 2008, look at this period. September of 2008, you had a massive balance sheet expansion from the Federal Reserve, and stocks were crashing like they hadn't crashed since 1929 because the system was falling apart, because the Federal Reserve was no longer in control and the market was getting concerned about the stability of the system. You can take a look at what gold was doing during this balance sheet expansion. It immediately bottomed and rallied significantly as stocks were moving down. And if we take a look at credit risk throughout that period in 2008, we immediately understand the situation. Again, let me add the balance sheet trends here. The Federal Reserve expanding its balance sheet here in September, October of 2008. Why was the market not rallying? Because credit spreads were rising significantly. Investors, the markets, were concerned about the stability of the financial system. Let's fast forward to today, and we can see that exact same dynamic. The Federal Reserve expanding its balance sheet, everyone getting excited about the fact that liquidity is coming back into the market. But look at what's happening to credit spreads. They're rising at the same time. Now, again, this doesn't mean that this is another 2008, but the same thing is happening. So you look on Twitter and everyone's talking about the expansion of the Federal Reserve's balance sheet, assuming that that's going to drive stocks higher. We have a beautiful example right in front of us, and you're definitely cherry picking evidence if you're not taking that into account. Today we have a recessionary market environment. The market is telling us today, ever since SVB, ever since the collapse of SVB, that a recession is coming a lot sooner and perhaps a lot harder than what we initially thought. Oil is coming down significantly. Gold is moving higher. Treasury bonds are moving higher as investors fly to safety. And of course, stocks have been coming down. All of these developments are recessionary, textbook recessionary price action, and it seems to have all triggered with the SVB collapse. Now, we've been positioned with our model portfolio on gameoftrades.net for the recession trade ever since February. Our model portfolio has been outperforming massively in this type of environment. Now, if we look at what is happening in the markets today, the S&P 500 seems to be fading that bounce that we saw. Now, another chart I wanted to show you in this video before we take a look at what insiders are doing right now. This is bond market volatility. This is the MOVE index that hit the highest levels here since 2008. And this was actually October of 2008. Now, it wasn't when the market bottomed, but it was during the height of the financial crisis. Now, if we inverse that chart, we look at 1 minus the MOVE index, and we add the S&P 500 on top of this chart, you can see how correlated these two have been over the past year. Bond market volatility drives the S&P 500. That's been the case throughout the entire bear market in 2022, and it's been the case even recently. But you can see we had a big divergence here where bond market volatility completely collapsed here, spiking very impressively, but the stock market held up incredibly well during this move. So there is a dislocation in the markets right now, a lot of optimism in the market, a lot of investors expecting that the Fed is going to save the day yet again. But if we look at what insiders have been doing, they've been selling. They've been selling their stocks here. And this indicator actually has a fantastic track record in the market. Now, very unfortunately, we don't have more data. I haven't found a way to download this data set and do some work on it, back test it against the S&P 500, but it does seem to work incredibly well. We made a video on it here about a month ago in February, where we discussed the fact that insiders were selling their stocks at a historical rate in February, the fact that the probability of a recession was rising very rapidly, and yet for some reason the market was rallying significantly. Now, today we don't necessarily have such a big reading on the insider transaction ratio. When the indicator is below this level here, it tends to be followed by periods where the market is rallying, and these spikes here above that line tend to be followed by periods where the market is weak. You can see here March 2022, August 2022, and the end of January 2023. All, of course, big tops in the market throughout the last year. Now, again, that doesn't mean that's going to be the same thing here. This video is really to give you a different opinion to what you're hearing on social media about the fact that the Federal Reserve is expanding its balance sheet again. Yes, that's absolutely true, but it may not have the consequences on the market that you think it does. So I hope you guys enjoyed this video. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.